Okay, so last year in 2024, they made $12 billion of cash. What do they do with that? Well, they peeled off 5.3 billion to put back in the business. Last year they borrowed a little bit of money, $700 million, a little bit of money, 700 million. Uh, but that basically left them with I'll call it 7 billion of cash flow from available to equity holders. So that's cash flow from operations minus capex. I'm going to put the debt offside for a second. Just call it $7 billion of free cash flow to equity. Then what are they doing with that? You can see that they're buying back shares. A lot of these mega cap companies do it. They do a great job and that's how they grow their earnings per share at above market rate. If enterprise level earnings are growing at 2% and I'm shrinking share count at 1%, then I'm kind of growing my EPS at 3%, which is, I guess, slightly above inflation, depending upon where you measure it. But that's not really what we want to see in a business. I want a business that's going to grow its earnings much faster. And then on top of that, if you buy back shares, it's even higher. But that's one of the problems, I think, with some of these massive portfolio companies of retail products. They're unable to really grow that quickly their main earnings.